Next up, please welcome to the stage Dan Dorner, head of the Strategic Initiatives Office at the International Energy Agency, Demetrios Papathanasiou, the Global Director of the World Bank's Energy and Extractives Practice, and Omar Vargas, General Motors Vice President and Head of Global Public Policy. This panel, Fostering Trade and the Energy Transition, will be moderated by FP's Executive Vice President, Allison Carlson.
Hello, everyone. I'm really excited for this conversation. It builds so well upon the conversation that we all just heard. Thank you so much for joining us, both here in the room and those online. I just like to remind everyone to please submit questions. We want this to be as interactive as possible. So if you're here in the room, there are the QR codes on your chairs. If you're online, you can see where the button is, and please submit your questions there. I'd really love to build on, what was just discussed, these investments that are related to not only energy security, but sustainability and the energy transition. It's clear that there's a lot of work to do. That has become apparent in the conversations here this week with the SDG stock take, and looking forward to COP and the conversation that we heard before leading up to COP 28. And what we're talking about now, building off the critical minerals conversation, is about value chains and strengthening value chains. And this demand is happening amid volatility in global markets. It's happening against the backdrop of COVID-19, the war in Ukraine, where these value chains have really been under stress and fractured in a number of ways. And when everyone is talking about needing to move faster, invest more, we need to assess, where are we really at? And in light of the demand that we're actually facing, what are the specific risks and how can we strategically address them? Dan, I'd like to start with you. Against this backdrop and in consideration of those factors, the IEA recently released the Energy Technology Perspectives 2023, which I think does a really good job of level setting in the present reality about both the risks and the opportunities in light of this demand. And so if you could share with us, to sort of set the stage for our conversation, what are some of these key risks, but also the opportunities and the big takeaways that you're seeing from the report?
Brilliant, thank you. I'm happy to do so, Allison, and it's a pleasure to be here. I think where we start is the fact that we are still actually in the relatively early phase of a new industrial age, an age of clean energy manufacturing. And as you referred to our Energy Technology Perspectives report, what it really looked to do was map from mining through to manufacturing, the state of this transition, this industrial age today, and how we see it evolving in the future. Because we're really looking to build a new multi-trillion-dollar industry. So that's the scale of the opportunity that we're talking about, and the fact that it is still relatively early, but evolving at pace. So the economic opportunities are huge, and countries and companies around the world are trying to seize them. And I think one of the points that we made was that really means that every country needs to identify how it wants to seize this opportunity, where its value add is, where its strengths lie, and make sure that it has smart industrial policy, industrial strategy to try and realize those opportunities. But again, bringing it back to the kind of here and now, we have seen the last couple of years in the context of COVID and other things, real tight supply chains, as you mentioned, resulting in cost pressures in a number of these technologies and base materials. But we also see there is currently a relatively high concentration of mining, processing, and manufacturing, so across all of the key stages, in terms of the geographic locations of where a number of these industries are developing. And it's been true in the energy sector throughout the different phases of its history that over-reliance and concentration is a risk. You don't want to be overly reliant on one company, one country, one trade route for something so critical as your energy system. Because if it fails for whatever reason, be it innocent or malign, that has such dire economic and social consequences, you just can't take those risks. So we see that as this age continues to unfold, as these opportunities continue to be there, one of the factors that needs to come in is a greater diversification of these, all of the elements of it, from mining to manufacturing. Now, that doesn't mean that we want to go from one country or one company doing it all to every country or every company trying to do everything. Then we'll lose the economic efficiencies there too. But countries have to think about their skills base, their resources, their existing industrial value add opportunities, and design, as I say, that smart industrial strategy accordingly. Because the manufacturing expansion opportunities are huge, the plans are already huge, and they're very dynamic. And the last point I would say is, as part of this evolution, what we also need to not lose sight of is the continuing value of international trade. We can see both now and going forward, we need to make sure that the trade routes that do remain free and fair, and that we can make sure that this system at the same time remains resilient and robust.
Very well put. There are a few things you mentioned that I'd like to pick up on and turn now, Demetrios, over to you. Dan, you were mentioning the multi-trillion-dollar investment opportunity. And indeed, and in your role at the World Bank, I am curious how you're looking at both the challenge and the opportunity. And when we're talking about the energy transition, indeed there are financing needs, and they are vast. How do you prioritize when you can't produce everywhere, just as you were saying, and you need to prioritize? And how do you do it? The need is grand, but how are you going to mobilize and deploy capital to the most efficient, most strategic places?
Thank you very much, Allison, and it's really good to be here. Thank you for having the World Bank in this event. Just backing up a little bit and to put things into a bit of perspective when it comes to costs and what is actually happening in the metals and the minerals. If one looks at the price, say, of a kilogram of copper in the early 2000s, it's around 60 cents or so. And then if you look at what is happening today and what has happened in the last 2 decades, it is about 800% as much. And prices are becoming volatile, but it definitely has stabilized at a level which is about 500% of what it used to be. And of course, this happened primarily because from 2000 to today, China had massive economic growth. Now, on top of that, what is really changing is that the energy transition requires different technologies for things to happen. So if you look, for instance, at combustion engines, the main thing in a combustion engine, it's just steel. And there's plenty of iron and steel in the world. And then all the value addition is about the manufacturing, the design, the small little things that go with it. But if you look now at electrification, then it's different metals. Copper is a big one. Cobalt is another big one with the current technologies that we have. Nickel is very important. And of course, lithium, because that's what runs batteries. And all of these are metals and minerals that nobody cared about at all 15, 20 years ago. They were all marginal. So this new focus on these new metals and materials, and the fact that we had this dislocation of demand in the last couple of decades, is creating a lot of uncertainty in markets. It makes it difficult for manufacturing companies to predict what their costs are going to be so that they know what is the cost of the product that they would then need to bring into markets, and makes everything much more difficult and much more uncertain. Now, the opportunity that we see in the World Bank when it comes to looking at all these metals and minerals is twofold. First of all, if you look around the globe at where do we have resources for these metals and minerals, a lot of these resources tend to be, and we haven't really explored in depth, but they do tend to be in Africa certain places in Asia, and in most of the cases, these are in countries that need to develop. And what we see as an opportunity is that there really is a second chance to use the fact that there's going to be this sustainable demand over the next 3 decades as the world is moving towards net zero. So we know that there's going to be demand for these key metals and minerals. And the question is, how can we really leverage these resources for the poor countries and help them really grow? So we've been working on that for some time now. To give you the most recent example, we made an investment, our private sector arm of the World Bank made an investment for lithium in Argentina. And it is an investment that was really welcomed in Argentina. And of course, Argentina is not the most popular, let's say, country for foreign direct investment in these late few years. But however, this investment went ahead, and it is really good both for Argentina and I think for diversifying supply chains. We have several such opportunities across Africa. We're actually working these days on a strategic approach for how do we help Africa develop on the back of these opportunities. And the bigger question, of course, is how do we do this right? How do we do it in a way that respects the environment, takes care of social issues, and helps governance get better? And this is where we really have the opportunity to shift things by working internationally and by, I think, bringing closer cooperation between the emerging demand poles of manufacturing. A lot of that is in OECD countries, in various OECD countries, and the opportunities that we have in Africa. So this is a lot of the work that we're trying to do. We have some clear ideas about how we can do that. We have been working as an institution in the mining sector for a long time, focusing on how do we help countries develop the laws and the regulation that can attract private sector investment. What we really need to be doing much more now, because there is this dislocation of demand, is figure out how can we help to build institutions in these countries that they can then be able to have conversations with investors, be responsive, and move faster. And I think this is one of the big challenges that we're facing and that we need to be doing much more on.
Very well put. And what you're speaking to also speaks to the timelines. Building institutions takes time, as does investing in manufacturing capacity, mining capacity, all of which is very much needed. But also, in the interim, what can be done to address the volatility and to adapt and to meet the demand that we have? And your example of the automobile is particularly relevant in this conversation and the panel. And Omar, I'd like to turn to you.
I know, I thought that was just from me.
And so that sets you up perfectly. From your perspective and GM's perspective, how are you thinking about this as there is increasing demand in the very near term for these range of minerals and metals? And also picking up on your comment about regionalization and diversification of supply chains. How are you thinking about that strategically in the moment?
Sure. And first off, thank you for having us here and participating in this panel discussion. I think FP is a fantastic platform for discussing the issues of the day, and looking forward to the conversation we're going to have for the next little bit here. A couple of reactions and to my co-panelist comments here in response to your question. So, first at General Motors, we are in a really incredible period and have been for some time now as part of our transition, our portfolio transformation over the next decade and in a couple of years from ICE motor vehicles to the electric vehicle. And there is an enormous amount of work being done. I have a great deal of confidence in how capital flows. Capital is going to flow where it's needed, where it's wanted, and where it will increase in value. What I worry about in the context of our transformation, I think it's the points that were made a few moments ago, it's will the policy environment be supportive? Will governments be supportive? Will countries be ready for this transformation that is occurring and now giving rise to a demand in minerals and other materials and workforces and geographies that have so far not been a priority in terms of the global trade environment. You mentioned Argentina. I think Argentina is a good example of a country that sits at a pinnacle of opportunity and a great deal of capital investment opportunity, but doesn't have the policy environment to assure investors that they can get their dollars out. What confidence does an investor have in being able to grow their business and therefore have a secured and sustainable and scalable supply chain? Because that is where supply chains are evolving to, or have been, frankly, I think. I think what we've learned, and to your point earlier, right, what we've learned since 2019, 2020 period in supply chains is that we cannot leave those supply chains vulnerable to pandemics and natural disasters and geopolitical risk. And so that evolution of supply chains has accelerated. There is redundancy built in. There's resiliency built in. That is capital intensive. It takes a lot of creative new planning. Policies need to support that. We have in the news today, concerns about migration flows across the Texas border with Mexico. For Mexico to really take advantage of the potential for nearshoring to supply the North American manufacturing renaissance that is occurring today, sure, there's a tax environment, there's maybe a security environment, there's a workforce environment, but what are we doing bilaterally at the federal and state levels to ensure that the products made in Mexico can come across the border? Because commerce still needs to flow. So these are some of the complications that we see now in our supply chain system that really need some additional thought through on them. And so if I were a policymaker or participant in the process, then I think it'll be critically important to think about the macro issues and then some really creative thinking about the micro issues. It could be migration, it could be workforce, it could be a variety of sustainable and governance issues. And those are the things that I think we need to be thinking about more creatively. Thank you.
Thank you for that, and I'd like to build on what you just said with another question or two, and we have a question from the audience as well. Thinking about how to be able to invest and assure investors you can, get your money out, and also building the relationships, the bilateral relationships and multilateral relationships that are necessary. Thinking about governance and partnerships and how that really translates, and how historically in many countries there's been resource extraction without the value-add investment at a local level that has resulted in some of the clustering partnerships with governments, and also ensuring that there is value add that will contribute to economic development, but also the flexibility, as you were noting, Omar, and access to markets and ability for product and value-added inputs to flow across borders. How are you engaging in those kinds of conversations so there is kind of meaningful change in the investment, but also strengthening of the cross-border supply chains?
Yeah, so just a couple of observations from our side. I think, if you go back to the time of the Paris Agreement in 2015, global energy investment was about $2 trillion, and it was split $1 trillion fossil fuels, $1 trillion clean energy. And if you kind of fast forward to today, that $2 trillion has now become $2.7 trillion. And it's still $1 trillion in fossil fuels, but now it's $1.7 trillion in clean energy. And by 2030, it needs to grow to $4 trillion to get us on track with a 1.5 degree pathway. The concern is all of the growth in the clean energy investment over that period is in the advanced economies in China. So across the developed economies as a whole, over that period, the investment in clean energy investment has basically been flat, which very much speaks to a lot of the concerns about the investment environment, the enabling environment, the willingness of capital to flow into those places. And that's absolutely something that we need to see change. And there is obviously a lot of work going on around the world to try and make that happen. And we do a lot of work, including just recently putting Clean Energy Finance in Africa report together with the African Development Bank, and really trying to identify how, including colleagues at the World Bank, can try and put their resources to the best possible use in terms of then leveraging the private sector capital that needs to come in, because public capital will not be anywhere near enough on its own. It needs to be leveraging in, at a scale of factors on top, the private capital to come in behind it. It's one of the prescient challenges that policymakers are wrestling with right now.
Demetrios, did you have additional thoughts on that from a financing perspective?
So, again, just trying to put things into some perspective, and Dan is right that the world will need to very significantly ramp up capital investments in clean energy by 2030 to about $1 trillion for the countries that we work in. That's not OECD countries. And indeed, if you look at the global, everyone, then we're talking about $4 trillion. Now, it's important to bear in mind that the world today spends, and for sure for last year where fossil fuel prices were quite elevated, the world is spending every year about 10 trillion on fossil fuels. So when you think about this recurrent spending, then actually, 4 trillion of investment is not such a big deal. Because we are spending every year more than 10 trillion. We did more detailed calculations on the power sector in the countries where we work in, and we left China out because China is such a massive market. And we saw that even the countries where we work in, which is low-income countries, middle-income countries, they still spend on fossil fuels, which is mostly coal, a big chunk of it is coal, and a significant part of the rest is gas. They're spending $500 billion every year, year after year, on fossil fuels. So raising $1 trillion or $2 trillion, actually, from a pure financial perspective, is not difficult to the extent that we manage to turn the spending on fuels into spending financial costs of equity returns and debt returns. Now, you did mention earlier, and I think you're absolutely right, that in the short term, right now, the world is in a difficult position because interest rates have gone up. We have the war in Ukraine that adds additional uncertainties in terms of the prices of commodities and the global outlook for energy and therefore economic growth. But I think it's important to look beyond that short-term problem that we have. And what is beyond that is that if we manage to shift the energy system towards renewables, then what we really do is we manage to have different levels of jobs. We have much less local pollution. A lot of people focus about climate change and the fact that indeed the planet is warming. But there are amazing benefits, especially in the countries where we work, where pollution at the local level is really bad and it is killing people at high numbers. And, we're not even putting that in the equation of when we're thinking about what is it that we should be doing. So I think that the argument of why we should move towards clean energy, despite everything, is very clear. Now, getting it done, it's also possible because, and we looked at the bank, we issued a report just a few months ago called Scaling Up to Phase Down. And we outline how we think this can work, how it has been working in countries, and what are the lessons that we got from it. And what we see is that this is actually possible. It requires a consistent approach. And the fact, as Dan mentioned, that you see renewable energy investments picking up globally and breaking record after record is really good news. And the best news of all is that we know that if this is sustained, and already we're beginning to see, for instance, in solar panels, that we are getting back into a trajectory of costs going down for material. Solar panels already, they had a hump in the last couple of years, but now we see again good signs that those prices are coming down. We have a long way to go on batteries. Batteries are at the moment a critical and difficult part. But I think if we maintain the policies, if the targets about decarbonizations are sustained, What this will bring is confidence for investors to go out in some of the more difficult places that, as we discussed, in Latin America and in Africa, because that is where we have the key materials, the key resources that really are needed for the world's decarbonization. So I think this is a sequence, right? I mean, people need to feel confident that we are indeed serious about net zero. This means that we're going to need new resources. This means that the investment needs to go to places that hasn't been going before.
Yeah.
And from our side, we're ready to support that, absolutely.
And to that end, I think the underpinning point here is being sustained. Sustained commitment in the investment, sustained partnerships, and continuing to be there and to develop the longer-term relationships in the countries where you're operating, where you're engaging in and sourcing some of your inputs. And so over to you, Omar, when you're thinking about those partnerships in where you're operating and where your supply chains are flowing through and, sustainable sourcing, how do you think about that? And understanding that is incredibly important to that supply chain resilience over the longer term.
Yeah. It comes with understanding one's commitments, like our company's commitments, and ensuring that that flows down through the supply chain. I think, when you were speaking just now, what came into my mind is that there are auto companies that argue that the electric vehicle is less sustainable than the ICE engine. And it makes me scratch my head. So I just don't get that. But maybe it's because there isn't the right flow down in sustainability and other governance practices. Right? And so companies like General Motors ensure that their principles, our commitments, are flowed down. That's the expectation of our supply chain. And when we think about our supply chain strategy today, and we've created a center of excellence to ensure that we're managing the supply chain transformation that is consistent with our obligations, we think about a sustainable, scalable, and secured supply chain. And I think if companies, manufacturers, other auto companies or manufacturers more generally were to follow those same principles, and I think we achieve the targets and the goals that you were just outlining, which it has to happen in a short time period for this to be successful. And if it isn't, then I think we've got some larger complications to deal with.
Allison, may I make a quick point? And I think we need to also think about new modalities of how we get this done and how we create resilience in the supply chains. One possible way, and we are in discussions with manufacturers, is, and you can imagine an auto company, GM, ideally taking equity in the development of a mine for the material they need somewhere in Africa. And this definitely needs to be backed up by a number of agreements, bilateral. Governments need to support that. But I think this is the way that we should be thinking. How can we do things differently, given the fact that we need to accelerate things, we need to reduce uncertainties for everyone, and we need to get, the demand and the supply closer in a way. And I think these new ways of approaches and these new solutions is what we need to push forward.
Absolutely, and I'm excited that you're talking about innovations and partnerships that need to happen to really underpin that, and that can also set an example of how else other relationships can be modeled. You mentioned trade at the outset as well. This trading ecosystem in more sustainable materials and inputs needs to be achieved, and it's exciting what's ahead, and there's tremendous opportunity, and you're each playing a role, so thank you for your contributions to the work that you're doing, our collective challenge, and thank you for being here.
Thank you.
Thank you.
Pleasure. Thank you.
And now, please welcome to the stage Dr. Holly Jean Buck, an assistant professor in the University of Buffalo's Department of Environment and Sustainability.